Hey everyone, welcome to Retire with Style. I'm Wade. I'm here with Alex, and we are ready to talk about the year in review as well as, it's getting a little bit late, I think, to just look at the year in review, but really focusing on what people thought was going to happen, what actually happened, and how you can apply that today as all these forecasts are coming up for what's going to happen in 2025 to take the lessons from 2024 and see what we can learn about 2025. Do I have the basic idea right there, Alex?
I think so. We'll see if
So
I have the
before
basic
we,
answer correct. But you're spot on, man.
yeah, last week Alex was asking me questions. This week we're going to do more of an investment themed episode, and I'll ask Alex some questions.
Fire away.
But before getting into the meat of the matter, what's new in your world, Alex?
Hey, you can't have it both ways, Will. You can't have it both ways, Wade. This is where what's happening in my world? I'm recovering from a bad bone bruise, if you will. So I haven't been playing pickleball for 2 weeks, and it's felt like an eternity. I never
You're
knew
talking
I
about
had
that
this much
hand
work to
one?
do. By
Or,
the way.
I know you had a hand bruise. Is that what you're talking about, or something else?
No, I was playing soccer with my kids in the house, which my wife
Uh-oh.
also loves. And
Yeah, I'm sure.
yeah. And I'm embarrassed to say, but they were coming. It was like one-on-one drills, and I obviously I faked them out incredibly. So no, I made a move, and he lunged for the ball, and I kicked my leg out to avoid that, but I ended up hitting the doorway. And my shin took it right on the bone. So it was one of those that there's a couple things I'm definitely afraid of: plantar fasciitis and shin splints from a soccer perspective. And so I just had to shut it down for 2 weeks. And,
Oh no!
yeah,
Did you break any vases also?
I have, but not
Not that one. It
not in
reminds me of the
not
Berenstain
in
Bears
that
playing
particular
soccer
moment,
indoors.
huh?
The Berenstain Bears teach us that not to play soccer indoors.
Bernstein Bear. Yes. I was gonna try to quote something from the sidewalk. What's the one? The Charles Traverstein, the end of the sidewalk. No, the sidewalk never.
Yeah, I know what you're talking about.
Completely
But
different, but
with it, no, I don't know. I don't know what it's called.
the
I know what you
the
mean.
sidewalk ends or something about the sidewalk and ending or not ending, right? So some funny thing like that. I always love those books. I think those are the only books I read, frankly. Oh,
Yeah, they didn't have a lot of words.
the other thing I told you about. Have you tried the hack that you and I were talking about the other day for reading?
I do not know what you're referring to now.
Oh, maybe I was telling Trevor. Yeah, I think I told you. This is where I buy. I'm a big Kindle fan, so I read on Kindle, but then I buy the same book on audiobooks.
Oh, for the $1.99.
Yeah, whatever it is, and then I listen to it on 2.5 speed while reading it. And my goodness, that helps me just focus in and plow through it. I've read.
Oh, you follow along with the words?
Yeah, kind of.
Huh. Yeah, you didn't tell this to me.
Are you
But
sure I
it
didn't
sounds
tell you?
interesting. I'm pretty sure.
All
I
right.
would have remembered this.
I think it's amazing. It keeps you on track, so it's great for my attention span. Simply because sometimes you can wander off. Never with your book, by the way. But you know how you can, you know how you can wander off and start thinking about your day or whatnot while you're reading, and then you're like, wait, what did I just read? And you go back to it.
Yeah.
And so it keeps me focused on that. And then by having the speed of it, I'm not a very fast reader. I try to just really go slow and comprehend. But that's not to say I can't go fast and comprehend as well. And so I found it actually quite well. I've read 3 books, probably in 4 sittings, doing this.
Wow.
Yeah. It's
And that 2.5 speeds, that's getting up to about where the limitations start, depending on the narrator.
it.
Can be a little bit of
No,
a struggle.
it's like Alvin and the Chipmunks reading the book, but I guess you habituate to that and you turn it off, in your head. But yeah, I didn't start at 2.5. I started at 2, then 2.25, and then I more than 2.5,
if you're reading along,
maybe, but not. I'm not there yet.
Okay, well, it's an interesting life hack.
There you go. But that's it.
So getting into
How about yourself? I gave a lot, Wade. I gave a lot. What do you got? Don't just say nothing at this point.
Well, I do. I tend to listen to podcasts. Well, 2.7 times speed is about as fast as I go, depending on the podcast. If it's a harder podcast, maybe 2 times speed.
Yeah.
I've never tried listening to audiobooks at the same time. I haven't really listened to audiobooks, and it can be tough to make audiobooks. That's a question sometimes we get about the retirement planning guidebook. Currently, there's no audiobook.
I've never,
since I update it every year.
Yeah.
That really creates it, and it's so long. It's tough to have a
No, I
narrator do
agree.
that.
I've never listened to an audiobook until this time, or at least I don't remember ever listening to an audiobook until right now. And I just did it more to almost like a metronome kind of function that it has for me.
No, it makes sense.
Well, I read, and I noticed a difference immediately. So there it is. That's a life hack. Follow me for more advice on Instagram.
There you go. Are you on Blue Sky yet?
Huh?
Are you on Blue Sky yet?
Blue Sky, like Blue Ocean Strategy?
I forget. You don't always follow the news.
Oh.
That's another new social media.
Oh, Oh, I got you. Yeah. No, I don't. Are you?
I have an account, but I didn't really do anything after that.
All right, man.
I don't have any posts.
Okay, and speaking about speeding things up, obviously we'll get some reviews about this little back and forth that we had. To those people, fast forward or don't listen. Your thoughts?
Yeah, and you can. Yeah, that is a life hack I use with podcasts. You can kind of fast forward through the beginning. A lot of podcasts do the opening before they get into the heart of the matter. They have some banter.
Yes.
You can fast forward.
This is very meta. Right now, this conversation is very meta, isn't it?
Right. But as we get into the matter today, so if you are listening to this episode very early in the day, it comes out on Tuesday, February 4th. We'll have a webinar at 2 p.m. Eastern time that I'll be doing on how much can you spend in retirement. If you want to register for that webinar, it's retirementresearcher.com. No, that's not right. It's risaprofile.com/podcast. And we'll be going at 2 p.m. Eastern time. You can also register and catch the review of that. But if you're listening to it much later in the day, it may be too late. And so let's get into the matter for the day, which is looking back at 2024, not just to review what happened, but really to learn from what people thought was going to happen, what actually happened, and some of the highlights of the year.
Yeah. I think at this point, with the speed of information, it does no good just to say, oh, the S&P returned this, and what do you know, right? I think what's more interesting is at the beginning of every year and towards the latter half of the previous year, like the last 2 weeks, you start getting prognostications for the upcoming year. And people take those to heart, and I think they take them to heart a lot. I believe they realize that obviously nothing is written in stone, but still they use it as guideposts for what's going to happen in the upcoming year. And those guideposts have knock-on effects on people changing their allocation, people sitting in cash saying, oh, let me not invest or let me go all in. Things like that based on prognostications. And it may not be on one person. It could be a whole consensus of them. And so what I used to do a lot when I solely just did the investments, I would always like to have a presentation ready. I titled it Profits and Losses. And profits being like the Bible prophets, PROPHET, profit, and losses, simply because you like that? You see what we did there? It's the
Prophets.
Yeah, prophet. Sorry, it's my accent. No, but we did that because it was good to have fun, right? And really level set that you have to hold folks accountable from the standpoint, if people year after year make certain prognostications and they're not even close to being right, then what's the point? But I think people just forget from one year to the next that, hey, who knew this was going to happen? And so that's why they were wrong. And so, but this is what's going to happen next year. And the reality is every year there's something that's going to happen. So that's not an easy excuse. And so just looking at 2024, because 2025 is, I'm sure you turn on CNBC, you read anything, it's what's going to happen. This is what's going to happen. And it's said with this level of confidence that it's not warranted, frankly. And so I always like to look at 2024, not by how the markets did, but what they said it was going to do and what actually happened, right? and
Mhm.
the S&P returned effectively, let's just say 25%. A little bit more, but let's just say 25% the S&P returned.
Total return.
Total return. Okay. I showed you the slide that I had.
For the second year running too, right?
Yeah, yeah,
So that's
which
kind
that
of
in itself is like pretty interesting. But I sent you the slides so you saw it, but what did you think would have been the highest expected return from one of the prognosticators, knowing that the S&P actually returned 26% and assuming that people kind of get this in the zip code, which you would think, right? What would you have thought if you guessed?
well, I must say you sent me this slide right when you said you're logging in, so I did not
Uh,
actually see it.
okay.
But
Okay. So what do you think?
I guess the more prognosticators there is, the maximum anyone would have predicted would be higher. But we're saying like not the highest estimate, which could probably be 50 or 100% or more, but a general high
Yeah, what
estimate,
would be a
probably a
general
little
high
more,
estimate? It's a loaded question, mind you, but you don't know which
probably around
direction.
15%,
Huh?
maybe around 15%.
15%. It returned
That's my guess.
26%.
Yeah,
The highest 13%. What do you think was the lowest?
the lowest, negative 20%.
Okay. It came in at 13 and 12. Like
Oh, wow. Wait,
the highest
the
when we look at
you're not averaging.
huh?
That's not an average. That's you have a bunch of people giving their forecast,
Yeah,
and
we
the
had
lowest
20
one was
people
low,
giving their forecast of the major like firms in Wall Street, if you will, the Goldmans, if you will. And
and their answers were all
the high
between 12 and
the
13.
highest no, the highest projected, sorry, I meant negative 12. The highest projected estimate was positive 13%. The lowest was negative 12. Right? And so the point here is that the S&P returned 26%, and these folks were way off, from the standpoint of they were under by half the highest one, and the consensus was in like that 4% range, if you will. And so this is where you have to ask yourself, like, what's the point of these? I mean, folks base their investment decisions on that, and look how off they were. The S&P returned 26%, the highest possible estimate among the top Wall Street firms, 20 of them, was 13%, and the lowest was negative 12. The consensus was in the 4% range. If you take the median, that's how I'm determining the consensus. So if you think about it, these are 20 people with a team of 20 people getting paid $1 million+ salaries, Ivy League educations, and they can't get it right. Now, this isn't me trying to jam on them for being like, oh, how can you be so silly, kind of thing. It really is more of a thing of they're fishing in a dry lake, kind of thing. The ability to forecast. A lot of folks think, a successful investment experience is being able to forecast. Hence, you're always asking, what do you think about the market? These are folks that get paid to do this, and they get paid to do this largely to instill confidence or to begin to give you a rationalization why they're changing their allocations, right? They come up with this sort of themes, and then they play off these themes, and then they say, okay, based on these themes, it's going to affect S&P earnings by this much, and if it affects the S&P earnings by this much, this is how it's going to then ultimately affect the returns. And they consistently get it wrong, from this standpoint. If you go, it wasn't just this one year, right? Again, the highest was 13. The consensus was in the mid single digits, and it was 26. But if you look at I'm looking here from a slide deck, right? But if you look at 2018, effectively here, the median estimate was 7.5% return. The market returned negative 6%. I'm using now round numbers just to make it easy. So they overestimated by 14 percentage points. In 2019, the median estimate was 13%. The market came in, hang on, this is a small number, at 29%. They underestimated by 15 percentage points. 2020, they expected 2.7. It came in at 16. 2021, they expected 1.2. It came in at 26.9. 2022, they expected 1.2%. It came in at negative 19. I'll stop now. 2023, they expected 6.8. It came in at 24. I mean, the theme is, why do they do this? I mean, you could just throw out random numbers at this point. In fact, the smarter thing would be I was looking at the numbers here. The S&P has roughly been 10.5% since 1927.
Yeah, so that's your best shot guess at being right. It's just going with
That's your
the
best shot
historical.
guess. But then here's the trick, and this is a loaded one. How many times do you think the S&P has returned within 10 and 11% since 1927?
It's going to be pretty low.
Yeah, just a guess. It is, but what's your guess?
So what percentage of the time? I'll say 5%.
Yeah, 5. Yeah, you got it dead on. 5 out of 99. So let's just say 5%. Pretty interesting, right? In terms of how, what the heck's going on here, from that standpoint. And so you might as well just do that, because what's the point of all of this? And the takeaway too is when folks are doing their financial plans, and right now they're putting their expected return for this year, especially if you're taking a sustainable withdrawal rate, right? Thinking, you know what, let me put 0% return this year because the new elections and this and that, we have to let that settle, so such and such, right? Why do that? You're making the same mistakes that these folks will ultimately make. And so the takeaway, again, as we level set before we get into this sort of, what happened in the markets this year, is when you're listening to prognostications, buyer beware, even your own, right? I mean, FactSet right now is reporting that in 2025, the S&P is scheduled to rise. Here, what do you think as a guess, just because we're having fun now? What do you think they would
Go
say?
with the historical number.
Huh?
I would just pick the historical number.
Yeah, fair enough.
Each
All
year.
right, so 10%. I would have, if I'm doing this without knowing anything, the fact that it's gone up over 20% the last 2 years, I would be like, oh, well, it's gone up that much.
Yeah.
The standard deviation on that 10% is probably 15, 17%, more or less. So even though it is within normal limits, it's on the higher end of that. I would probably think 7, 8%, just for the hell of it, if I'm saying it. But no, the average consensus here, it's coming in at 14.5%, 14.8%.
So higher than average.
Yeah, exactly right. That's pretty ambitious. Not because of the forecast, but just because, not because I'm not sanguine about the U.S., but more, why not just do 10%, right? From that vantage point. But it's interesting that they're saying that. But I mean that, for me, the lesson is be careful as well when you're doing your financial plans, and pretty much ignore whatever anyone's going to say right now, because again, they don't know the random information that's going to come in. I mean, Monday alone, right now it's January 29th, so on the 27th, on Monday, Nvidia dropped $600 billion of market cap. It took the entire tech sector with the AI bent with them. Why? Because news came out that DeepSeek has created, from China, has created a significantly more efficient way to develop and train large language models for AI. Initially, the whole thought was they created the whole thing, for I think it was like $5 million, right? And everyone's going, what? When in reality, they were just piggybacking off the infrastructure that was already built. And they did find a more efficient way to train models, which will reduce things by orders of magnitude. And so markets have been correcting from that day on. But the point is, this information came in randomly, and boom, who would have thought? How can anyone predict something like that, right? And the effect that would have. And that's the silliness of this all, is what I think. Like, trying to play that game is just too tough, and really, the better way to go about this is just, your job as an investor is not to be able to forecast. The bad news is no one can forecast. As you just saw, these Ivy League education, I think all of them went to Princeton, Wade. What do you think?
Probably. Yeah, there's always the schizophrenic nature of all that financial education. Like, even going through the CFA program, they tell you can't forecast any of this stuff, but then they also try to teach you all the tools to make these forecasts.
Yeah,
so
looks like there must not be enough graduates from Boston University in this batch of prognosticators. But yeah, I mean, it's not a matter of intelligence. It's to some extent it's a little bit of hubris, I think, but ultimately is they're playing a game that they can't win. And that's the bad news is, to be a successful investor, you can't forecast. The good news is you don't need to forecast. Our job is to capture market rates of return. As we saw, the average was such and such, and capture that. It's not going to happen every year, but if you just stay disciplined and capture that and ignore all the noise from the daily news cycle, you'll be a much better investor over the long term. That's my takeaway from what you're hearing now in terms of 2024. I'm bringing up 2024 because these were all the predictions. None of for the most part, they didn't come to pass. If by some chance someone had hit that, what are the odds they're going to get it again? The de minimis, zero, right?
Yeah,
Well, it's a
broken
non-zero
clock is
thing.
right twice a day.
Say it again.
A broken clock is right twice a day.
Yeah, so maybe one more time, but but that's it. When it comes to that, and so that's my takeaway on what you're hearing now about what's going to happen to the markets going forward and the like. And by capturing returns, if you really think about it, if you look at 12-month rolling periods from 1927 to September 2024, right? And that means that you're controlling for a lot of stuff. There's a lot of autocorrelation here that makes this a little, there's a lot of dependencies of the samples, but let's just have that heroic assumption put away right now because it's fun to play with numbers, if you will. If you take a yearly rolling return, that means from January 1927 to December 1927, and then from February 1927 to January 1928, and so forth. You just do that continually, right? If you do
rolling
that,
historical,
right? Over a 1 year period, the market is positive 75% of the time, right? Over a 5-year period, the market is positive 89% of the time. Over a 10-year period, 95% of the time, right? When you compare it to cash, did it outperform cash over a 10-year period? It outperforms cash 86% of the time, right? And so that's where this idea of time diversification and just capture returns that are available for the taking. You do that enough, there you go. Now, somebody may be thinking, heck, why not 100% equity portfolio? Wade, I've spoken a bit. Let me ask you that question. In consideration of what I just said, that it's not about forecasting, hence, by evidence of what we just reviewed, why not just put it in 100% equity if you see over a 10-year period, it's going to be positive 90% of the time, 95% of the time. And I'm sure over a 20-year period, now you're getting into the 100. What would be your response?
Well, that's something that may resonate with more probability-based folks. It's not going to resonate with safety-first folks. Yeah, definitely the probabilities are in your favor, and we do see from time to time advocating for 100% stocks. I think we even had in our Q&A episodes, someone had asked about that. But you have to consider your risk tolerance and your ability to stomach short-term market volatility, and that could be a pretty wild roller coaster ride, and not everyone is suited to withstand and not panic and stay the course with that kind of really concentrated, volatile investment strategy.
Yeah, 100%. The other one is, the S&P went up for the year, let's say 25%. Just if you were to guess, how many up days do you think there were as a percent? It went up 25%. So
last year was a roller coaster. I think we talked about that too. Like we had some periods where it kept going down day after day, and then it recovered pretty quickly. So
you just guessed.
Maybe it was up 2/3 of the days last year, down 1/3 of the days, something like that.
Okay. It was up. I'm doing this not because I knew before asking you. I have it written down. So it was up 58% of the time. So that's, 252 trading days. That's 146 days, roughly speaking. It was down 105 days. So every 1.5 day that goes up, one goes down. Think about following that every day. And think about every reason at the end of the day why this happened. When it nets out that much, right? It's like, what's the point? To your thing, the biggest drawdown, that means consecutive down days in which that, what was the biggest percent down? It was 8.4%. It went down 8.4% between July and August, mid-July and early August, right? It took the market about, I have it here, 32 days to recover, trading days to recover. That's not bad, on many levels. So
Yeah, kept hitting new historic highs and then having those big drop-offs and then recovering again.
yeah, there were a lot of highs during the year. The chart, it was too many green dots for me to sit down and and count them off, frankly. But the other piece that I think worries people is, oh, the market's hitting new highs. I should stop now. The reality is, it's the market's job to hit new highs. If capitalism is working, if the economies are working, it should be going up. Earnings go up. That's how it is. So there's nothing actually wrong with that. In fact, it's you kind of that's not necessarily a bad thing. That's fine from that vantage point. So yeah, it
Okay,
was
so
it was a pretty interesting year in that regard. Go on, Wade.
yeah, you're hitting some of those like market ups and down type highlights. Any other special events that happened in
Yeah, there were
2024
a lot
that's
of
worth
current
mentioning?
current events, if you will, but I don't need to rehash that. Everyone always sees those news, the year in review on the news and things like that, where you know, I was trying to make it funny, but I can't right now. I think what was interesting is at the beginning of 2024, you had an inverted yield curve, and those are things that those portend a recession, right? Another reason why get out of the markets, right? That kind of thing. Oh my God, the market is pricing in a recession. Look at the yield curve. Now, if you look at inverted yield curves, there is something to that, but unfortunately, there's a lot of false positives of that. They predicted, the joke is what, five out of the last two recessions.
Oh yeah.
Like what, I don't know what the actual joke is, but it's something along those lines. But interestingly enough, the yield curve, with the Fed, they had three major movements. They went up. They went up by 50 basis points in one shot, and then they have two consecutive on a monthly basis, 25 bips and 25 bips. And so you can make the case that was somewhat brute force, bringing the rates back up. But ultimately, the yield curve is in line with what you would kind of expect, relative to the numbers and the spread between the low and the high years, who knows? But it's taking on the shape where it's no longer inverted. And so that's an interesting take from the standpoint of, the bond markets kind of give you a sense of the expectations of what's going to happen. And, we just went through a few years of everyone saying, okay, well, rates have kind of adjusted. The bonds took the brunt of that, not this past year, but the year before that. They did. I think the aggregate bond market was down about 1% in 2024. And in my estimation, considering everything that has happened over the last 3 to 4 years within the bond market, you know what? There's a lot of people that would take that in a heartbeat, right? That kind of performance in consideration and how it's set up now going forward. So that was, to me, something that was of great interest from the standpoint of something that happened in 2024.
Okay. Now, another couple issues that I think we hear about quite a bit. So the S&P 500 had a really good year, kind of tended to outperform some of the other market indices. Anyone who's been investing in international stocks for a long time has been underperforming the US market. So maybe a question that people may have is like, is international investing dead, or should they only invest in U.S. stock markets, or is there still a role for global diversification?
From my view, this is one of those things that you see every 3 months. I'm sure you'll start seeing it. Yeah, the S&P, gave you 25%. The international developed markets, I'm using the MSCI EFI index effectively. Well, the MSCI World XUS rather, that came in at 4.7. This is a 1 year period. Over the last 10 years, the S&P has been annualized at 13.1, which, just take a step back. Look at all the things that have happened in 10 years. And the S&P is coming in at 13% annualized. That's pretty good. And as an aside, it shows you also the silliness when everyone gives you this every year. This is what the sustainable withdrawal rate is right now, based on what we think the market is going to happen. That kind of thing. But yeah, the S&P last 10 years, 13%. International, 5%. It doesn't take a genius to say, wow, what the heck am I doing here, right? From that vantage point. But even then, I'll still caution. Look, at the end of the day, there are always just infrastructure items and things like that you can consider and you can point to say, haha, that's why. But, if you look at the numbers, it's a little more than just that. I'll start by saying there's no reason to think. Let's say those GLP and GIPS drugs right now. Let's just take Eli Lilly, right? I think they do Zepbound, and let's take Novo Nordisk or whatever. They do the Ozempic, right? And they're based in, I want to say, Denmark or something like that. Not here. They're in Europe, right? There's no reason one of those should outperform the other, right? And so, to me, from the standpoint of investing, you want to expand your opportunity set if it's going to provide the same type of expected return. The benefit of that is that they may not, the pharmaceuticals may happen, may be a high correlation, but in general, if you aggregate European stocks that are similar like that and you aggregate domestic stock, there's no expectation that one should outperform the other because of some secret thing or because of where they're domiciled. It just is what it is. I mean, at this point, they're all globally exposed, right? The benefit is that you just have a wider opportunity set from that for diversification. Like the S&P 500, well, why invest in the S&P 500 when you can invest in the S&P 1000 for the same expected return? Kind of thing, right? In addition to that, there is a diversification play where there is a higher correlation, but it's not one. From that standpoint, I mean, just evidenced by here. 1 year, 25%. The other one was 4%, right? But it could be where next year the international returns 14% in the S&P 5. And from that side, you just want to be there for those opportunity sets. Why? Because underlying that is the expected return for a developed international stock market in aggregate versus a U.S. stock market should be relatively the same. And if you look at the numbers here, there's a couple things. If you remove the Magnificent Seven, I said MAGA, oh my goodness. If you remove the Magnificent Seven, help me out here, Meta, Alphabet. And I was going to say Google and Facebook. I was like, oh, they changed their names. Meta, Alphabet, NVIDIA, et cetera, et cetera. If you remove those from the S&P 500, the S&P 500 was just a smidge over the EFI, right? Now, don't get me wrong. They're still in the index, and they deserve to be part of that, et cetera, et cetera. But I say that to show you how concentrated the S&P has become with regards to these large players. Now, granted, the S&P, because it's a market cap weighted index, you're always going to have that type of representation from high stocks. But I just want to point out, from a breadth standpoint, there wasn't much of a difference. The U.S. is fortunate, that these companies happen to be domiciled in the U.S. and not in Denmark, if you will, from that standpoint. But that being the case, if you look over the longer term, I mean, here, I'll tell you here from the things. From 1970 to 2001, and I'm using 2001 because effectively international stocks have underperformed the U.S. since 2011. All right? Since 2011, there's been that schism where the U.S. has just continued to outperform versus international on a year-by-year basis, right? But there are long periods of time where that's just not the case. And those long periods of time represent investment horizons, right? And so from 1970 to 2001, the U.S. returned 11.56%, 11.5%. The U.S. world ex-U.S. returned 10.9%. So that's a difference of about 0.5% every year. It's not insignificant, right? But then in 2002 to 2011, that switched. All of a sudden, the U.S. from 2002 to 2011 returned about 3%, whereas international stocks returned 5.5%, right? There, the U.S. underperformed, annualized, for a significant period of time, roughly 10 years, by 2.6 percentage points a year. So now, let's take 1970 and bring it all the way down to 2011, right? So I gave you two snippets where one outperformed the other for a significant period of time. Now bring those two snippets together, and what's the net? From 1970 to 2011, the U.S. performed 9.46% annualized. International stocks, 9.62%. Let's just call that a wash, right? I mean, technically, the U.S. underperformed by about 0.16%, but let's just call that a wash. Now, the benefit that you get from that is the reduction in standard deviation because you're bringing in these two asset classes that actually, as you saw from those returns that I showed you in the first and second one, there was a difference in those returns. Aggregate, they end up being the same. Within the portfolio, through the magic of diversification, you get kind of the only free lunch available, which is you reduce the standard deviation, having those two asset classes in a portfolio. Granted, since 2000 and change in 12 or so, we've been in that. U.S. has had a heck of a run, right? Not too dissimilar from January 1970 to December 2001. But as the song from Barbara Lewis goes, our day will come, right? At some point, if you're an international investor. So you have to remove recency bias from the equation. And recency bias isn't, oh, the last 3 days this has happened, the last 3 years this has happened. No, we're talking investment horizons. And investment horizons, to be able to be statistically significant, to be able to get a T-stat that's greater than 2, you need to have a lot of sample sizes within that. And so that's not me being cute. That's just the name of the game when it comes to determining, is this worth it versus not? And so from a recency bias example, I would say hold that thought. There's still plenty of reasons you would want international exposure. And as I've shown you in the example that it just went through, there's these things come and go. I wish I could tell you when that would happen, but I can't. And the reality is no one can. I mean, if these the first chart I showed you, when these Wall Street analysts are kind of predicting what the stock market is going to do, when they absolutely can't do that, what makes you think they can drill down even further and let you know that international stocks are going to outperform domestic stocks this year, and that's where you should be? Right?
Right. It's a challenge.
Challenge.
So another question that comes up, and I have a feeling the answer might be similar and maybe related to these magnificent 7 you were talking about, but small cap and value, we expect there to be a premium because of the risk for investing in small cap stocks and value stocks.
Yeah.
But they've underperformed. Are they dead? Or is
No. What's the Mark Twain quote, right? I've been widely over exaggerated, but I'll say this, and you use the word risk. I believe there's a risk story to tell, but there's a lot of research coming out that it's not necessarily a risk story. It's, to some extent, some people say it's a behavioral story that you're seeing. To some extent, you could say, listen, whether it's a risk story or a behavior story, it doesn't matter, because it's a systematic thing that you're seeing. It's not something that once it's recognized, it gets priced out of the market, right? Ultimately, that would be a bad thing. Hey, this is priced out of the market. And small caps, the jury's still kind of out there. But that being the case, I want to present to you, I saw this and I thought, this is a great explanation of why investing in value, to me, makes a lot of sense. Now, before I say that, I have to level set. There is nothing wrong with a market portfolio. There's absolutely nothing wrong if somebody holds a globally diversified market portfolio, like the global version of the S&P 500. Or if you want to be 100% domestic, the S&P 500. Why? Because that's how the world chooses to allocate its capital. And so that's fine. Any deviation from that is some sort of quote-unquote bet. So I can't argue with that, right? That being the case, I believe there's different areas of the market that present interesting risk profiles, and that it's not an inefficiency. It's just you're compensated for taking on extra risk in certain areas of the market that not everyone wants to go all in on, that kind of thing. That being the case, year to date, large value, returned 14.7%. I mean, 14.37. Let's just say 14%, right? Large growth, 2024. Large growth came in at 33. Small value came in at 8%. Small growth came in at 15%. Right? So what's going on here? And this is probably at this point 10 years of underperformance for both value and small relative to growth. And if I say value and growth, the market, the S&P, so think about S&P 500 value index, S&P 500 growth index, and then there's just the S&P 500, which is a blend, if you will. And the blend is always somewhere down the middle, right? So you have to ask yourself what's going on here. Now, there's two ways to go about this way, and that's because the value stocks, to me, the risk story is value stocks from an accounting term, their price, when you look at them at price to book, that means they're selling very competitively relative to the growth counterparts from a price to book standpoint. That means that you can just take the tangible value of their assets, sell it, and you'd get a higher return relative to the price that they're being sold for right now in the stock market, right? That kind of thing. And so a price to book ratio of 1 indicates that if I were to sell the furniture in this business, everything that's tangible, I could sell it for $20, and it happens to be that it's selling at $20 price per share in the market. So that would be a price to book of 1, that kind of thing. And so stocks that are priced with a low price to book ratio, they're almost being sold at a discount relative to their book value. Why? Because there's usually something going on. There's usually some distress. And I'm setting this up because value can get more valuer, right? It's that catch a falling knife phrase, right? And so you want to make sure that the value index, is AI, is technology taking over the world, and all these old school companies are going down. They're going down the path of the horse carriage relative to the car. And an interesting way to look at that is to break down the price to earnings. And because you want to get a sense of what's really the breakdown of this separation over the course. And what I mean by that is if I look at value stocks and the quality of their earnings have gone down significantly over the last 10 years, then maybe there is something to be said for, this is a depleting well. These companies are all going to obsolescence, kind of thing, relative to their growth counterparts. And so if you break down large growth by their price change and large value by their price change in the US, the price change over the last 10 years for large growth they've gone up 320%. This is the Russell 1000 growth has gone up 320%. The Russell 1000 value has gone up 77%. So growth stocks have gone up 320% versus 77% of value. So the price in this equation, price to earnings ratio, the price has gone up 320% versus 77%. The earnings for these growth stocks have gone up 145% versus 50% for their value counterparts. Interestingly enough, right? So the price has gone up 2.2 times the rate of the earnings for growth companies, and it's gone up 1.5 times for value. To me, that indicates that, value, okay, the price has gone up 77%, fine, modest, but their earnings have gone up 50%. So if the earnings have gone down 50%, that would be a significant, whoa, what's going on with this whole group of companies? It stayed relative, it's been healthy, I would say. And frankly, I'd be more concerned about justifying a 320% price increase with only a subsequent 145% earnings increase over the last 10 years. Obviously, the market is pricing in future growth. From that standpoint, that's the only way to do it. So the change in PE ratios for large growth stocks, they've gone up 72% over the last 10 years, meaning that their PE is now 37%. Right? Whereas the PEs of large value companies, their PE ratios have gone up 18%, but they're still at 19.7%. Right? And so to me, I still have a healthy exposure to value. And again, this is not investment advice or anything like that. I'm just giving you my hot take, if you will. And Wade, chime in. But if you have the large growth, their price to earnings ratio over the last 10 years have gone up 72%. Right? For a current PE that's standing at 37% relative to large value, where they haven't been decimated from a fundamental standpoint, is what I want to bring home. The spread between value and growth isn't this fundamental accounting thing. The spread is just due to this idea that growth is going to go on forever and ever, and that's when investors are not willing to pay $37 for $1 of earnings as opposed to $19 for $1 of earnings in the value. I'm fine with that, in terms of my exposure to value. And again, I think everyone has heard us over the last years at this point that they know we're not forecasting or anything like that. I'm just kind of seeing, is there something fundamentally off with value? My answer is I don't see it. You, Wade, what's your take on what I just said?
No, I don't dig as deep into the weeds on the investing topics, but I still feel comfortable with the idea that small value should have long-term potential. So
Yeah, there it is. Yeah, no, I agree. And so that's where, when people say, oh, it's value's time to now, sector rotation, now it's the value play, now it's the growth play, now it's the whatever. I don't care about that. I'm just taking it from the standpoint of, look, there's nothing fundamentally wrong with value. You know what? I believe it's a risk story in the sense that they have higher cost of capital. And because they have a higher cost of capital for investors to invest in them, there's a higher implicit expected rate of return than for growth companies. Based on the fundamentals, that hasn't necessarily deteriorated to the point that, oh my God, you're buying a whole bunch of horse carriages at this point, as opposed to, cars. And so that's what I'm looking at when I see that. Now, the same case could be made for small caps. Small growth, effectively, U.S. small growth and U.S. small value. Interestingly enough, you see the same thing between small growth and small value as you saw with large growth and large value, but to a lesser extent. What's interesting to me is that small growth, this goes back to, do I invest in growth stocks? Relative to others and based on earnings quality. Small growth over the last 10 years, the price has gone up 104%. Small value, 62%. The earnings of these companies, small growth has gone up 122%. So the price has gone up 104% over the last 10 years. The earnings have gone up 122%. For a small value, the price has gone up 62%. The earnings have gone up 114%. You're flipping the equation that what from what you saw in large. If anything, the fundamentals, the earnings fundamentals for smaller companies look quite sanguine to me. Not that I'm making a prediction, but they just do, just on balance. To the point that the PE ratios on small value is 14.3, but there's not this degradation of earnings. So to me, that makes a lot of sense. And let's finish it off with international. Over the last 10 years, think about U.S. stocks, right? Over the last 10 years, international stocks, the price has gone up 27%. The earnings of those companies have gone up 28%. Almost like a one-for-one relationship there. Sitting on a PE of 16. Remember, I didn't... Let me go back to the U.S. S&P went up 186% with a 96% run-up in earnings. So it's almost the other way. It's almost a 2-to-1 ratio with a PE of 27. And so to me, regardless of what happened in the past, in terms of, you take the information of what it's telling you right now, I feel completely fine with having an allocation to international stocks, having a nice allocation to small cap stocks, and having a nice allocation to value stocks, knowing full well that, yes, this demarcation between the two may continue, but on a fundamental earnings basis, I'm fine with it. I don't have an issue with it. I don't quarrel with that. That would be my takeaway. And to me, that's the best answer that I've heard when it comes to, should I allocate to value? Shall I allocate to size? Shall I allocate to international stocks? To me, it's, you want the opportunity set. And based on what I've just reviewed, there's no reason to think that the opportunity set simply isn't there anymore.
Absolutely. Yeah. And it's not a matter of forecasting,
No.
but just pointing out that, if you're diversified in these asset classes, don't abandon hope. There's no particular reason to do that. It's still, over the long term, no reason to expect that these won't eventually just have their time to shine.
Yeah. I mean, it would be very different if the PEs for value went down because the earnings had gone down by 70%. That kind of thing. But you just don't see that. And so what we did from a mathematical calisthenics standpoint is not too different than what you do when you're kind of doing the expected market return going forward, where you take the dividends, et cetera, and you just roll it up into an expected return. That's kind of what I did there to begin to analyze these differences between them. So In terms of the review for 2024 is, listen, there were a lot of forecasts that went wrong by so-called smartest people in the room because they're playing a game they can't win. There's no reason to continue that insanity in 2025. Number one. And then, sure, asset classes, and so the S&P had a great year. I mean, it really did. But, does that mean that it's going to be negative 20 next year to make up for the plus 20 this upcoming year? No. I think, as Wade said, the average is probably the central tendency is the best here. And I would continue with that. And then the other question that folks always have is this whole value versus growth, size versus large, international versus domestic. And I think we broke that down in how to think about that based on what happened last year going forward. Well, based on what happened last year and the years before that, how to think about that going forward. And I think that's a wrap, my friend.
Yeah, thank you. Nailed it.
There it is.
All right. So thanks everyone for listening to Retire with Style. That's your year in review and what you can learn from that on a looking forward basis. And we will catch you next time on Retire with Style.
Thank you, everyone.